Good day everyone. Today, I'll be presenting the finding of my study on the factor affecting the credit risk of Malaysia Building Society BERHAD MBSB from 2014 to 2023. This study aims to assess both internal and external factors impacting MBSB credit risk and how they have shaped its risk management practices. Let's begin with a background of MBSB. Originally, focusing on how low-cost housing finance, MBSB has grown into one of Malaysia's key financial institutions, offering a range of services including personal loan, Islamic banking, and wealth management. Following its merge with Bank Muamalat in 2022, MBSB have continued to be a major player in the Malaysian financial industry. It is regulated by Bank Negara Malaysia, ensuring its stability and adherence to financial guidance. In 2024, MBSB faced a significant financial challenge when a fraud case resulted in RM34.2 million in losses. This incident exposed vulnerabilities in their credit risk management, leading to unauthorized withdrawal from customer accounts. It not only harmed liquidity, but also increased credit impairments, which is why understanding both internal and external risk factors is crucial for improving MBSB financial stability. From this, we developed the following research objective. First one, to identify the internal factors that may have an impact on the credit risk of MBSB Bank. To determine external factors may have an impact on the credit risk of MBSB Bank. And the last one is to look into the potential external and internal variables that influence MBSB Bank's credit risk. This translates into our research question, such as, is there any relationship between MBSB Bank's credit risk and internal factors? Is there any relationship between MBSB Bank credit risk and external factors? And the last one is there any relationship between the credit risk of MBSB Banks and internal and external variables? Credit risk refers to possibility that a borrower will default on their obligation, leading to financial losses for the lender. Effective credit risk management is crucial for maintaining financial stability. Key practices include assessing a borrower's creditworthiness using financial metrics and tools such as credit scoring, collateral, and loan covenants. The Basel Committee on Banking Supervision stressed the importance of credit policy and ongoing monitoring. Loan loss provisions are essential in managing risk as they set aside funds to cover potential default. These provisions help banks absorb loss and remain solvent during economic downturns. External factors such as GDP growth, inflation, and interest rate also significantly impacting credit risk. Economic growth generally lower credit risk, as borrowers are more likely to repay loans, while recession increase default rates due to job losses or declining income. Similarly, inflation can erode borrowers' purchasing power, increasing the risk of default. The capital adequacy ratio is another important factor, as the higher CAR indicates a bank's ability to absorb potential losses. Additionally, exchange rate fluctuation can affect borrowers with foreign currency debt, raising credit risk. In conclusion, both internal control and external macroeconomic conditions play vital roles in managing credit risk, and understanding these factors is essential for financial institutions to maintain stability. The study uses data from MBSB annual report from 2014 to 2023, as well as macroeconomy data from Malaysia. I use three analysis techniques, which is descriptive statistics to summarize the data, Pearson's correlation to examine relationship between variables, and ordinary least square (LLS) regression to analyze how internal and external factors influence MBSB credit risk. We have three models, which is Model 1, focus on internal factors, Model 2 on external factors, and Model 3 focus on internal and external factors. Moving on the descriptive statistic based on Model 3, which combine both internal and external factors. Credit risks show moderate fluctuation over the years, reflecting the combined effect of internal management practices and external macroeconomic factors. For instance, loan loss provisions and leverage exhibit notable variability, indicating changes in the bank's approach to risk management and borrowing. On the external side, variables like inflation and GDP growth also show significant fluctuation, highlighting the economic pressure faced by the bank. Notably, reserve money 8.23 and M2 money supply 1.91 have high standard deviation, suggesting how sensitive the bank liquidity is to change the broader economy, especially during periods of uncertainty. In terms of correlation, the most significant variable is risk-weighted asset (RWA), which has a negative correlation with credit risk. This suggests that as the RWA increase, credit risks tend to decrease, likely because higher RWA often reflect more robust capital and risk buffer, which can help absorb potential losses. On the other hand, variables such as liquidity and return on assets show weak correlation with credit risk, indicating that although important for assessing financial health, they have little direct impact on the credit risk of MBSB. Looking at the model summary, Model 2, which focuses on external factors such as GDP, inflation, and interest rate, has the highest adjusted R-square value at 0.735. This indicates that external factors are the most powerful in explaining the variation in MBSB's credit risk. Model 3, which combines both internal and external factors, has a relatively lower adjusted R-square of 0.384, suggesting that the addition of some internal factors may not have significantly contributed to explain the variation in credit risk. This highlights the dominant role of external factors in shaping MBSB credit risk during the 2014 to 2023 period. The ANOVA results indicate that Model 3, which includes both internal and external factors, is statistically significant with p-value of 0.001. This suggests that the combination of internal and external factors does indeed explain a significant portion of the variance in MBSB credit risk. In contrast, Model 1, internal factors, and Model 2, external factors, did not show significant results in explaining credit risk, reinforcing the idea that both internal and external factors might be considered together for a comprehensive risk management strategy. Finally, examining the coefficient, risk-weighted asset and regulatory capital emerge as the most significant factor influencing credit risk in Model 3. The negative coefficient for RWA and REGCAP suggests that higher level of risk-weighted asset and regulatory capital are associated with lower credit risk. This makes sense because a stronger capital base and more diversified asset allowed the bank to absorb potential losses and reduce the likelihood of defaults. On the other hand, inflation and GDP growth also show significance, with positive coefficient indicating that period of economic instability marked by rising inflation and low GDP growth, increasing the bank's exposure to credit risk. This finding aligns with the past study that suggests macroeconomic instability leads to higher default rates as borrowers struggle with higher debt burdens during such times. Interestingly, loan loss provision and debt to equity ratio do not show significant impacts, which suggests that despite their importance in risk management, they might not have been as influential in this particular study period. This could imply that the external macroeconomic conditions play a more crucial role in driving credit risk compared to internal credit management measures. In conclusion, external factors such as GDP, inflation, and exchange rates have a stronger influence on MBSB credit risk than internal factors. These findings highlight the needs for MBSB to enhance its credit risk management models, especially in response to macroeconomic changes and uncertainties. My recommendation for MBSB includes improving internal management practices such as credit evaluation and loan loss provisioning, and closely monitoring macroeconomic indicators. Additionally, during periods of economic uncertainty, MBSB should tighten lending criteria and update its risk model to account for economic fluctuations.